So what do gold and oil have in common? Not a lot, and that's what makes this a very good ratio to use to assess the health of the global economy, gauge market sentiment, and identify potential economic shifts by tracking the relative value of the two major commodities. So if you trade gold or just want a fast read on market stress, this not well-known ratio might be very useful for you. So what is the gold-oil ratio? Well, the gold to oil ratio is simply the price of an ounce of gold divided by the price of a barrel of oil. It's usually WTI oil. In other words, how many barrels of oil does 1 ounce of gold buy? And that's it. No PhD required. Pretty straightforward. So why does this ratio matter for you as an investor or a trader or someone learning about the markets? See, when the ratio jumps, investors are crowding into gold for safety, while oil, the real fuel of the economy, softens. That's essentially your stress signal. Now, on the other hand, when the ratio falls, oil demand is healing, growth looks better, and most importantly, stress is easing. It's always very important to understand what the market thinks is happening and what the market thinks will happen. And this is where the gold-oil ratio becomes very useful. For context, the gold-oil ratio has a rough range that it likes to stay in historically. It's about 10 to 30. And in major economic events, the ratio will spike in one direction. Big spikes usually show big nerves. So this is how to use it. If you open a chart, if you see the ratio is surging and can't make lower highs, assume risk off is in control. Tighten risk. Shorten time horizons. Be picky. However, if it's rolling over and making lower highs, that's your early hint the market's exhaling. In other words, energy demand is stabilizing and risk appetite is creeping back. So, does this ratio actually predict gold in any meaningful way? To be honest, not really. But that doesn't mean the ratio isn't useful, because as I always say, understanding what's happening in the broad market can only help you in understanding gold. And of course, like any good investor, I'm assuming you've diversified your portfolio. See, very importantly, gold's real engine that drives growth is something called real yields. It's basically interest rates after inflation is factored in. So here's a cheat code I'll give you to understand all this. If the gold-oil ratio is high, but the real yields are falling, that's a strong sign for gold overall. Of course, there's other factors, and this is not financial advice. Alternatively, if the gold-oil ratio is high, but real yields are rising, be cautious, because that's a stress signal without the fuel behind it. I hope this makes sense the way I'm describing it. It's not just the market moving, it's kind of like the power behind the move. Now, if you want one more, even important thing to cross-check this with, peek at the good old VIX. Of course, I'm sure you probably were expecting that. The VIX is very useful for market volatility. So if the gold-oil ratio is up, and the VIX is also up, that confirms there's stress in the market. So keep it simple, really. The gold-oil ratio is kind of like your 30-second stress detector. Use it for context. Confirm all this with real yields, and of course the VIX, and then make your call. But this is not financial advice. Just trying to give you a smarter dashboard, especially to get you away from using indicators, if that's what you're currently using, because indicators need to have context behind them. Otherwise, you're just trading blind. But I digress. So please subscribe to this channel if you want more useful ratios, as well as to keep up to date on the latest gold news. Thank you.